Now, the Monetary Policy Committee meeting met on 5th, 6th and 7th December. Based on an assessment of the macroeconomic situation and its outlook, the MPC decided by a majority of 5 members out of 6 to increase the policy repo rate by 35 basis points to 6.25% with immediate effect.
Hello everyone, welcome back to today's topic of the day. Today, we'll be discussing about the RBI's monetary policy announcements. Now, the Monetary Policy Committee, constituted under the Section 45ZB of the Reserve Bank of India Act 1934, held its meeting on December 7, 2022. Now, there are certain decisions that were announced. The MPC decided to increase the policy repo rate under the Liquidity Adjustment Facility (LAF) by 35 basis points to 6.25%. Consequently, the Standing Deposit Facility (SDF) rates stands adjusted at 6% and the Marginal Standing Facility (MSF) rate and the bank rate to 6.50%. The MPC also lowered its growth forecast at 6.8% from 7% for the current financial year amid concerns over the bleak global economic outlook and retained its retail inflation forecast at 6.7%. Now, there are certain reasons for the repo rate hike. The RBI has hiked the policy rate in a bid to bring down inflation from the current level. Inflation in October eased to 6.77%, a 3-month low, but it remains well above the RBI's target for the consumer price index inflation of 4% within a band of plus minus 2% while supporting the growth. Also, the major worry for the central bank is the rise in the core inflation, the non-food, non-oil part of inflation that increased again after moderating over the summer. Now, let's see the impact of RBI's decisions. The lending rates of banks are expected to go up as the cost of funds is expected to rise further. EMIs on vehicle, home and personal loans will also rise. Deposit rates are also expected to rise in the near future. The external benchmark-linked lending rate of banks will rise by 35 bps. 1 basis point is 1/100th of the percentage point, as such loans are linked to the repo rate. Now let's see the instruments of monetary policy. Repo rate. Repo rate means the interest rate at which the Reserve Bank provides liquidity under the Liquidity Adjustment Facility (LAF) to all the LAF participants against the collateral of government and other approved securities. Standing Deposit Facility (SDF) rate, the rate at which the Reserve Bank accepts uncollateralized deposits on an overnight basis from all LAF participants. The SDF rate is placed at 25 basis points below the policy repo rate. Marginal Standing Facility (MSF) rate, the penal rate at which the banks can borrow on an overnight basis from the Reserve Bank by dipping into their statutory liquidity ratio portfolio up to a predefined limit, which is 2%. The LAF corridor has the Marginal Standing Facility rate at its upper bound ceiling and the Standing Deposit Facility rate at the lower bound, with the policy repo rate in the middle of the corridor. And the bank rate, that means the rate at which the Reserve Bank is ready to buy or rediscount bills of exchange or other commercial papers. This rate has been aligned with the MSF rate and the changes automatically as and when the MSF rate changes alongside policy repo rate changes. Let's take a practice question from this topic. Consider the following statements relating to recent announcements by Monetary Policy Committee (MPC) of India. Statement 1. The MPC decided to increase the policy repo rate under the Liquidity Adjustment Facility (LAF) by 35 basis points to 6.25%. Statement 2. Due to the hike in repo rate, the external benchmark lending rate of banks will also rise by 35 basis points. Now, which of these statements given above are correct? You may take a moment and give your answer in the comment section below. Now, the correct answer is C. Both statement 1 and 2 are correct. I hope you liked the video and found the information useful. You can also check out our daily current affairs section on our website for further details. And for more such updates, stay tuned to NEXT IAS YouTube channel.